Portfolio Builder members, welcome to our Monday Trade Alert. Another day, another dime. In this case, a couple dimes. We pulled in a profit of 27 cents, just a little bit over a quarter, but we had 1,700 shares of the SPY working for us over the weekend, and it pulled in a nice profit of $459 per block of 17 contracts we had trading the SPY. So let's take a look at how we generated these profits over the weekend, what our forecast is for the rest of the week and into next week, and how we plan to generate retirement income from the prognosis. So the previous trade alert was much better. We had a $2.39 profit. That I told you was abnormally high. In order to achieve our 1% return per month, which is our target return with extremely low risk, we really only need to pull about 25 cents profit per share on average 3 times a week, 52 weeks a year. So let's just take a look at the previous trade alert that got us into today and how we got out of that trade. So on Friday, we sold to open the 301 call option for a tiny credit of 17 cents, and then we reinvested that 17 cents into downside insurance. This is what makes the trade so safe. In this case, we paid a debit of 10 cents to enter that option caller, and the effect is that we would give up some of the potential profits if the SPY were to trade above 301 over the weekend. And in the same breath, if something bad went wrong, like, for example, bloodshed in China, aggravation with the U.S. Trade war, something along those lines, which, by the way, is continuing to escalate. In fact, now we've got the Hong Kongers running around with "We want Trump to free us" signs and "Make Hong Kong Great Again" hats. So tensions are still there. We definitely still want to have that downside protection so we can sleep like a baby and make this trade setup what I call atomic bomb proof. Speaking of which, what's North Korea been up to? So this was our trade setup: sell to open the 301 call, buy to open the 295 put. All that means is we have to sell our shares for a maximum profit of 301. If the best news in the world came out and the SPY was trading at 310 today, we would miss out. The fear of missing out feeling is something common with our program. We don't care. We want to generate safe, consistent retirement income. Now, on the other side, if something bad had happened over the weekend, the SPY crashed to 290, 275. I've seen moves in the range of $10 to $20 in a single day in the SPY, just in the recent time period where we have extremely low interest rates, relatively free money gushing around the world, and yet the liquidity in the stock market still seems to get dry and cause these panics. So regardless, our trade setup was safe and we made a profit. So let's look at how we got out of this trade today and how to do the accounting to see how these profits slowly but surely pile up. So this is the turtle strategy, definitely not the rabbit. This is not your growth strategy. This is your safe, conservative income strategy. Okay, so let's just first start by looking at how to get out of the trade. In this case, our put option's only worth a penny. Don't try to sell it. No one wants it. It's worthless. What you do need to do is buy to close your September 9th, 2019 301 call option. So you'll pay a penny back and be out of the contract to sell your shares for 301. Now, we didn't get anywhere near 301, so we made a profit on the short call. We lost on our put. Let's look at the net result and how it all adds up and why we're doing a very similar setup. In fact, even more aggressive today than Friday. I think we have some very handsome profits coming our way in the SPY, and we'll show you why in a minute. Okay, so here's all you need to do to audit our returns or your own returns. When we enter the option contract, I want you to get a piece of paper out and write down what was the SPY trading at when I entered the contract. So I'll just show you In this picture, you can see the trade alert. We were trading at 298.33. So you can see 298.33. That's where we started at. Let's see what we spent to put on our option collar. 10 cents. So we paid a debit of 10 cents. So that's going to go out of our profits. Okay, so there's our negative 10 cents. Now, how did we get out of the trade? Well, we had to pay another penny back today to exit that trade right here. So we lost 11 cents on the option collar. We made 38 cents on the SPY. Better than a sharp stick in the eye. We made 27 cents in our portfolio. That's 1,700 shares. That's $459 of income. May not seem like a whole lot, but get this. If we can pull this off 3 times a week, on average, 52 weeks a year, well, with this size portfolio, that's $71,000 a year of income, or a 13% annualized return. Now, I've got news for you. We're on track to do a lot better than 1% a month. And I do suspect the remainder of the year will be very easy pickings for people who are invested in the SPY ETF. Now, sure, there's going to be some very important things to look out for, and we'll go over that right now in a moment. So this is our return per month on the SPY program. We have one losing month recently in July, where it's really my fault. I was predicting before it would happen that Trump would raise the tariffs. And instead of just reacting to him actually raising the tariffs, I was on a trip to Hawaii for Dean's wedding, and I just wanted to play it super safe. So we aligned our option contracts in July to actually make a ton of money if those tariffs had come on in July. My thought process was that if Trump is going to raise the tariffs, he better do it quick. Before this 2020 election. Well, he ended up doing it in August. It did catch us off guard. We reacted once he did increase the aggression with the U.S.-China trade war. And you can see we walked away with a 1.6% return in August, despite having to deal with the flip-flop in terms of what we're expecting out of the trade war. Because remember, in July, they came out of Japan at the G20 meeting saying, hey, we're going to be friends again. So I thought perhaps they'd be kicking the can down the road. Regardless, it really doesn't matter. Our strategy is so simple and so safe, and we can react so quickly to whatever Trump or President Xi decides to do that it really doesn't matter. It allows us to be part of the momentum of the stock market and pull off these safe gains. So that's our current trade alert, how to get out of it. To get today's trade alert, you're going to need to go to your email to find the current trade setup. Now let me take a quick break and see who's chatting with us. We got some people in there. Scott, welcome. Richard, welcome. Thanks for saying hi and coming on. Anybody else live that wants to say hello in the chat? Any questions? We've got 10 watching right now, and so that's very good. Did you take the last 2 trades, Scott or Richard? I'll check back in that chat in a minute to see if we got any interaction going on. So that's just a quick review of how we are performing in the SPY over the weekend. And I'm suspecting some gains that'll be more like this one that we came off on Friday, where we didn't make 27 cents a share. We made multiple dollars, in this case $2.39. Now, again, we're not trying to pull off $200 a profit contracts in these short period of times very often. And the only way you can get those sort of gains is when the SPY moves in a certain direction very rapidly. So luckily, we do have a setup right now that is extremely bullish for equities, especially U.S. equities, if what I suspect is about to happen. And that is that the ECB, one of the bigger central banks, is supposed to unveil, they've been hyping this up. It's funny for central bankers to use this sort of wording. They're calling it a bazooka of stimulus. And then next week, we have the Fed probably will drag their feet, but still drop rates 25 basis points. We've seen them starting to pick up some 10-year treasuries to the tune of about $15 billion. So the big picture is that we're headed towards lower rates, going to push towards that 0% lower bound, and I think all these central banks will start buying up government debt because no trade deal is going to resolve. So we'll look at the big macro news in a minute, but again, these are our last two trades. If you do want to make sure you don't miss any trade alerts, it's really simple. Call Dean right now, 505-322-7515. Upgrade your account, activate it. We'll rush out today's trade alert and make sure you don't miss out on tomorrow's. We're doing a really good job. I think people who do make it into our webinar, which is Thursday at 1 Eastern for free, you can see we've actually had some of our paid members coming on completely unsolicited, talking about how well they're doing. In fact, I haven't met a single customer who has joined us that doesn't have very close to the same returns we have, except for when they mess up, and they always admit that it was their fault and not ours. Okay, so let's take a quick look at our total strategy. We'll jump into the macro news, and again, we may start throwing out some bonuses for people who will take the time to post in our chat. Just a little teaser for those of you listening live who have not yet written in our chat. So far we've got Richard and Scotty chatting with us, so we appreciate that. All right, so here's a look at our total portfolio. We're currently allocated a little heavy in stocks if you are following my portfolio exactly. And that's because I have 38% in the Monday, Wednesday, Friday trade, taking advantage of that SPY ETF that has option expirations 3 times a week. I've got a smaller position in the Tuesday trade. That's where I'm trying to handpick a specific stock or security that I think has the best potential return with the least risk week over week. So the catch is we're going to take on more risk, but we're trying to get a better return. And you can see it has done that with twice the profit in terms of return on investment over the same period of time. Now, I realize it's much riskier, so I'm not putting a ton of money into that relative to my SPY trade. And that's because I want ultra conservative safe returns. Now, year to date, we are definitely outperforming our target of 1% a month. Okay, we got Richard saying this is Tom. Oh, shoot, it's not Richard, it's Tom. Sorry about that, Tom. Been following it since May. Very conservative strategy and consistent gains. Thank you so much for saying that. We really appreciate getting those comments. For everybody else out there, you know, they may think this is too good to be true, or they may think it's complex. What do you think? Is this hard to follow? And so, again, we're a little heavy on equities. If you go back, what is it now, 2 weeks ago, we actually called the top of the TLT for a short breather. And I was very nervous because despite calling that the SPY was going to jump back towards new highs back when it was at the 280 level, which we nailed it. We made a lot of very nice returns from that. The bond market was not doing its natural thing where it would sell off a little bit. So to me, for quite a few days, in fact, until last Thursday, actually, I was just perplexed that we had nailed it in terms of predicting that stocks would rally up aggressively, but the bonds were not believing it. They were not selling off. None of the money was flowing out of the bonds, taking some profits and heading over to the equities. And then by next Thursday, the TLT crashed, which was great because we had actually given everyone a trade setup. In fact, one of our members, Kirk, shout out to you, he text messaged me, nice call on the TLT. Probably made a fortune on that. And by fortune, we're talking about trying to pick up anywhere from $1 to $2 a contract, or rather per share. But today, the TLT continues to sell off, and the SPY continues to rally, getting towards those levels. So this is our current setup. It's heavier weighted in equities. It's pointing down in the bond market. And I grudgingly do that. This is the first 2 weeks that we've actually bet down on the bond market as we've been playing it to the upside all year. It's had a tremendous gain. It's not normal to have a better return in your bond portfolio than your equities portfolio, but that's just what the market's handed us this year. the TLT has been one heck of an easy ride. And so we are actually outperforming in the bond portfolio versus the SPY portfolio. And it's been quite boring in terms of the trade setup on Thursday. You could predict my trade before I put it out week over week over week until I guess about 2 weeks ago when we finally did start to bet down on the TLT. Let's see, our precious metals portfolio still sitting pretty at 53%. GDX is getting hammered today, but I'm not worried whatsoever by the dip. For all of those who are wondering if I'm still bullish on gold, answer is absolutely, positively yes. And, oh yeah, we got a question here from Legal Beagle. Thanks for coming in. Just signed up for the trial, says great stuff. Can you elaborate on the precious metals crypto portfolio? Yeah, I sure will. Let me just jump into that before we get into all the macro news. So currently, this is aggressive. I want you to be very well aware that if you go look at like Ray Dalio's portfolio or Drunken Miller, or even you go listen to Peter Schiff, who's the ultimate gold guy, to recommend a 10% position in gold is pretty aggressive. And then to say, all right, well, we're going to actually not just buy gold, we're going to buy GDX, which is the gold miner ETF. So gold miners, they have terrible businesses for quite some time where they've been losing a lot of money. So this big scare with U.S. and China has been really a lifesaver for them. And they're finally starting to get their financials in order, start getting these operations rolling. And so if you're going to buy GDX, you want to basically believe that there's going to be a long-term demand for gold at elevated prices. And so most of the year we were not buying GDX. In fact, we were playing GLD, which is spot gold. And not until we saw Trump raise those tariffs in August have we been really aggressively increasing our position size and then saying, all right, let's get rid of GLD, which the central banks could potentially, if they really get scared about the macro environment and about the U.S. trade war, China trade war, they may start buying up gold at rapid pace and essentially putting a ceiling on the price of gold. And I think it may be stuck in this 1,500 to 1,600 range because the central banks are clearly loading up on it. I just saw a newswire that China just added 100 tons of gold. Russia's been buying, mainly China and Russia have been your big gold buyers. But we've also seen people like Ray Dalio, Drunken Miller, some big hedge funds starting to pitch it. Right now it's still in this, do we really need gold, the old barbellic relic sort of feeling. But the reason I like GDX is because I do believe that the U.S.-China trade war will continue for a much longer time. And despite the risk that the central banks may try to put a ceiling on the price of gold, the new flow of gold creation is going to rely on a basket of about 30 big companies that are very well organized in GDX. So it's an absolutely beautiful ETF in terms of what it holds. Its top positions are the top positions for Drunken Miller with GOLD. And then NEM is the second biggest gold miner, and you got your big mutual funds like BlackRock dominating that. So I really like GDX. Buy the dip. My recommendation, if you want to keep your life super simple, 10% of your total portfolio should hold GDX, and you got to hold on to it through the good times and the bad times. I'll look at our monthly return on this portfolio so you can see it has had to hang on to some pretty significant losses in the 10 to 12% range in a month in order to capture much larger gains in the 10 to 40% range. Now, the big catch is if we see the Chinese start to really purchase up agricultural products, I would be very concerned about holding, at this point in time, such a large allocation of gold. Now, if you want to really spice things up, consider, so this is 10%. So if you had $100,000, you'd have $10,000 in GDX. If you want to spice it up a little bit more, I would put 1% into Bitcoin and 1% into Ethereum. So you'd have per $100,000, you could drop down to $8,000 worth of GDX, $1,000 worth of Bitcoin, and $1,000 worth of Ethereum. And it's quite funny, despite gold having a little bit of a sell-off today, especially in the miners, the crypto, which is your rebel without a cause currency, it's funny what exactly its purpose will be, especially if things like Libra come into play. Now we have the Chinese talking about building their own Libra so that they can keep their currency strong and remove the reliance on the dollar. We've got Binance saying they're going to build out the rebel without a cause version of that for the crypto world. And then we got Facebook, obviously, trying to do it for the U.S. So anyways, that's how I would do it. If you did want to shave off another point on GDX, buy SIV, and that is your silver miner ETF. And that's a whole different set of very small little companies that specialize in mining gold. And again, from what I understand, they had very bad balance sheets, hanging on to lots of debt, not really doing very well until this big story has come on. Now they're rushing around to raise capital, start getting all these mines back in operation, and seeing how much gold and silver they can produce. So that is how I'm recommending you balance it. I do want to be very clear that 10% is aggressive. I would never recommend such a high percentage unless I was quite worried about the future. And so we'll go over a few things that I think could change the risk of the future in terms of why do we have $16 trillion in negative yielding debt around the world. Clearly the bond market is not believing the stock market. So that's our current recommendation. Does that make sense, Legal Beagle? Any other questions on that? All right, so that is our review of that. Let's go back to the big picture. So yeah, here's a quick little summary for folks. Quick disclaimer, throw that up. Our portfolio is a model portfolio so that we don't get accused of front running. However, there are quite a few people on our staff who do actively follow the product. They do not get the content before anyone else, so they have to wait for all the messages and content to go out at the same time as everyone else. Now, with that said, we're not trading penny stocks. We're not doing illiquid options. We're not chasing NVIDIA. We're not doing credit spreads. We're not playing futures. Who knows what all kinds of crazy stuff people get into these days. Binary options. It goes on and on. We're trading the most highly liquid products in the world. There's nothing else that is as liquid as what we trade. So from that standpoint, nobody's front running anybody. From the next standpoint, these have such tiny spreads. You're going to get the same price as us. And then to make things better, when the trade alert's going to come out. Exactly, noon Eastern. So we've made your life very easy, very passive, and very conservative. So I have 3 setups for you. I'll just rotate through all 3 so you can get a quick look. Depending on how many days a week you're willing to trade and how much capital you have, one of these 3 setups makes the most sense. So if you have $100,000 to put to work, and I do want to throw out, if you use our recommended broker, which we're going to get a special link for everybody probably tomorrow, Interactive Brokers. This is a sort of strategy where you could put 50 grand into Interactive Brokers, and they're going to give you $200,000 of buying power. And normally I would say don't use margin, you're crazy, but you can see we're trading in a setup that's extremely risk adverse. And so I do know quite a few of our members are definitely leveraging up so that they can have many more contracts to profit from each trading period. Here's our $100,000 portfolio allocation. That makes a lot of sense. 100 shares of the SPY costs you approximately 30 grand. 100 shares of Facebook. Facebook's been a little bit of a dud. I'm a little disappointed. We're going to hang into that. We'll decide what we do tomorrow on that one. What I told investors is our plan for the Tuesday play was that I believe the SPY is headed to new highs. And this was way back after a big crash. You trying to wonder if it was time to short the market. I said, no, it's not. We're about to bubble up faster than you guys have ever seen. So I said, long SPY for the Tuesday play. Our trade setup has been, we're going to hold on to Facebook till the SPY breaks above 300. After it breaks above 300, I want to hold something a little safer because I suspect as the SPY gets too expensive, Trump is going to want to start poking China some more. And so clearly, if we haven't figured that out, it's amazing how short people's memories are. But when that does happen, it's hard to time. We don't have, and I do have some funny graphics to show you guys about when Trump apparently sleeps based on his Twitter feed. Not much. He's busy. From the moment I go to bed till the moment I wake up, I'm typically seeing a stream of tweets, which is great because that's the only Twitter account you need to predict all of the markets right now. Never in the history has there been such a simple way to be able to accurately forecast what's going to happen. So Facebook I want to hold till the SPY is above 300. Then I want to rotate into something I would say has less volatility. Microsoft. It's the top spot in the SPY. It's the number one largest position in Druckenmiller's portfolio. It's the biggest position in almost every high quality portfolio out there. And what's going to happen is Microsoft will probably just drift higher for us on that Tuesday play when we know equity prices are risky, they're expensive. We'll still have that downside protection. But when we do get that surprise, if it comes sooner than I expect, we're not going to take a big hit relative to something that might be more volatile. Now, I do like Facebook for a lot of reasons. Libra is way down the road, so if you think I was playing Facebook because of Libra next summer, no. But I do like Facebook because it has an absolute monopoly in its business model. It's very young, so it's just now starting to monetize its huge user base. But more importantly, what I like about it is it has a monopoly in the phone app space. And I think that's greatly undervalued by investors right now because people just don't understand. The trend is that we're dumping all our desktops and everybody's just going to use their phone. And so if you control all of the time usage on the phone, you're in a very, very lucrative position. And that's what Facebook has. Now, sure, we won't go on about Facebook today. That's tomorrow's trade alert. But our time is running out for Facebook to deliver a big win. So next up for that will be Microsoft. And then if we're really lucky, and I can predict the tariff tweet before it happens, we'll be able to ride Microsoft maybe for a week or two and then switch into SLV. So I'm not using the Tuesday trade to try to speculate to the upside on silver. We're going to be trying to use silver ETF to generate a very handsome income strategy where we, again, sell the covered call, buy the put. TLT, we did another downward bet Thursday. Reluctantly, it's paying off big time today. And so usually I like to use the TLT as a buffer to be able to make up for any losses while we're long the SPY. But I was so convinced of the move that was coming that I was willing to align our options to profit up on the SPY and down on the TLT. So we have done extremely well on that. Now, if you have been listening to me, I said, hey, this is probably a period of weakness in gold. But you got to remember, we got two huge things coming that will be bullish for gold. And this is outside of the U.S.-China trade war escalation, which every time it does escalate, we're seeing another bid into gold. And that is, simply put, the ECB has been forecasting, and Christine Lagarde is coming in, the most dovish central banker of all time, used to run the IMF. They're all signaling that they're going to be extremely, extremely dovish. They're talking about the word bazooka of stimulus. Now, we have heard mixed messages coming back and forth. We've heard banks in Europe saying we can't survive with these low interest rates. So that's why we're not 100% in on gold, obviously. But those events, and also next week, where I suspect the Fed will do 25 basis points, the least they can do to keep everybody happy. So this is a great allocation setup. Again, the Monday through Friday trades have put options below and we sell call options above. Typically, sometimes we flip the collar upside down, and that's what we're doing on the TLT right now. So we actually are never in a predicament where we have to have the asset go up to generate a profit. We can use the options market to to change the setup so that we can profit if it goes flat or down, depending on what our forecast is. Right now, my expectation is very clear. I think SPY is headed much higher, and I think the TLT is going to, TLT and gold are going to kind of just be in a building phase where they just sit flat for a little bit, maybe a little bit of weakness. Okay, so here's another setup that's very popular for people who don't want to trade specific stocks, which inherently have much more risk. Throw out the Tuesday trade. It's no big deal. The SPY is much safer. It has 504 companies, and what's even more interesting is that it has 3 option expirations a week. That means we can track the movement in the news 3 times a week. Anything bad happens, we just optimize our option contracts and we can immediately benefit from any surprises. Now on our Tuesday play, I won't do that. I will never ever interrupt the trade midweek because that makes the strategy much more difficult for our followers to be able to get the exact results as us. So, if you want to tell me whether I think you should cover a position early in the week, I'm always going to say no, I will not touch the position until the designated trading period. And that's why, of all the advisory products out there, this is probably the only one where actually everyone gets the same results. And not to rag on other advisory services out there, but a lot of them, a handful of insiders go buy these small cap stocks and then they send out the trade alert, the thing goes flying up, and then moments later they're selling it right when you just barely got in, and now it's crashing. And so it's just despicable. And that's why, again, we will never trade our positions outside of the designated time and spot. And we're only trading the most liquid products out there. So, again, we're never going to be having people get different prices, different fills, or anything of that nature. Now, you want to make a better return than the SPY, you're going to have to take on more risk. This trade setup costs a lot less to get going, and it has extremely high returns. The Tuesday play is already up 20% this year. And I want to point out, it's up 20% without buy and hold, without a growth strategy. It's done this while giving up tons of profits by buying put options and selling covered calls. Covered calls limit your upside return, and typically in our setup will help finance the downside crash insurance we want to have. So I'm very happy with our return on the Tuesday play. Facebook's been a little bit of a dud for me, unfortunately, but we'll see what we do with it tomorrow. This setup has the same bond equity ratio, has the same general idea. You're going to see a little more volatility. You might have some months where you lose a couple percent, but you're going to have months where you make a couple percent. And so this is definitely an option worth considering. And again, if you did not get today's trade alert, or you just have questions about how to get going, call Dean. He's very friendly. He's an expert trader. He is very, very in tune with the markets and what's going on in our exact strategy, and he can help you sort things out with your life and figure out what makes the most sense for you. So call Dean, 505-322-7515. All right, let's jump into, you know what I'll do is I want to show you guys that Tuesday track record, and then we'll jump into the news. Okay, so there's your total return of 19%, but actually this year, you can see there's that nasty 4% loss in December during the Christmas massacre. Now in the SPY, we were able to squeak out a 0.5% return because we're optimizing the portfolio so frequently and we can react to downside moves. In the Tuesday trade, I won't do that. I just will not do that because it makes the product hard to follow and not passive. But you can see we've had some pretty big returns in a single month. 7% in January, in June 6%, August 2.5%. So just this year, that's up 24%. Quite remarkable considering we have the downside protection on at all times and we're giving up a lot of the profits by selling these covered calls. So, okay, that's a wrap of talking about what's going on in our various track records. Let's look at the news and our forecasts and see if we can predict the future yet another week. And again, I think if you're noticing what our general strategy is we really just have to predict essentially three things. Is the stock market going up or down based on the big macro view? Are interest rates going up or down? And you gotta love the way that works. They literally tell you what they're going to do from speeches all month. So the bond market's been relatively easy to predict. And not only do our own Fed speakers tell us what's going to happen before it happens, for the most part, we're also able to just simply look at what all the other central banks are doing. And if you don't think all these central banks are in cahoots with one another, I've got news for you. They all work for the banks. So they're not working for Congress. They're not really trying to create some sort of stability or certain inflation number. No, they're trying to support the banks. So if we can predict the big picture relatively accurately, it makes our job quite easy with having a balanced portfolio that can generate safe, consistent income. So let's take a look at what I'm tracking and what is making me think we have a bullish stock market ahead and probably a flat or bearish period for bonds. Gold, I don't think will be very bearish. So while we have been betting down on TLT, I have not done any sort of put option buying in our buy and hold portfolio to try to protect that gold position. Okay, so let's take a look. Here are the top stocks that I am watching daily. We're not trading all these daily, but we're watching all of these daily. Let me just see if we have any more comments or questions in the chat box. We'd love to hear from more of you. We're now up to 14 live. I do want to throw out that you can drag that little cursor backwards if you want to restart the live stream and listen to it till the completion. Because my presentation usually does have a beginning, middle, and end, so you don't want to just jump into the middle and then you miss the whole start where I showed off our trades and market predictions. Okay, emerging markets. This is the ETF that people like Ray Dalio, Jeffrey Gundlach, Stephen Druckenmiller, a lot of my heroes have been betting big on for quite some time, and they've been, arguably very wrong with that play. Now, questionably, do they have funds from China that skews their outlook or maybe even entices them to say nice things about it? So everybody has their hands dirtied from some Chinese money, which is primarily what you're investing in when you buy EEM. So I do like to keep a close eye on that ETF, as well as FXI, which is a little bit more concentrated into the Chinese banks. We had been putting some put options out on FXI, and we're able to pull off a few of those profitably. A few of them we let just hold, and those did not pull a profit yet, obviously. GDX is the gold miners ETF that I'm endorsing instead of GLD right now. In terms of trying to predict a stock crash before it happens, or at least realizing that there's no more ammo for a return of the bull market, perhaps equities will figure this out before these do. But these are 3 ETFs you can follow that will give you a good measurement of the health of whether we can maintain a bull market in stocks. So we got HYG, high yield corporate debt bond. It's kind of your bottom of the barrel corporate borrowers. Of course, if they can't get access to capital, which they're just using to buy back their own stocks instead of CAPEX or hiring people, well, that's going to hurt at least the lower spectrum of stocks in the S&P. IWM is the I Russell 2000. That's Stanley Druckenmiller's favorite chart to watch in terms of whether he thinks there's a long-term bull market ahead or not in equities. And it's been having a hard time recovering from all the volatility over the last few years. So that is definitely looking weak. And we'll look at charts in a moment. LQD, investment grade corporate bond ETF. So that represents your Microsofts. It even has some people like GE and AT&T in there who quite potentially should be downgraded. In fact, Jeffrey Gundlach is the one who's been saying that there's a huge block of this LQD ETF that is misrated. And if it were to be re-rated, it could be devastating for the credit markets. So far, LQD has been a straight shot up this year and shows that the access to capital for companies like Apple, Microsoft, Facebook, etc., the top of the SPY, they have free access to as much money as they want, and they're just using it to buy back their own stocks. So until that circle is broken, it's going to be difficult for me to bet down on the SPY for more than just a very short period of time. And that's only when we see some sort of panic in the newswire that is pretty serious threat, like something like Trump and his tariffs against China. And then we got the SPY and the TLT. All right, let's look at some of these charts. Here's that SPY. Again, I am expecting this to break above 300 and to enter what I'm calling a danger zone. That's probably in the 310 to 330 range. Hard to predict exactly how high it will go. You got to remember, the main buyers are not your typical retail mom and pop who wants to speculate as to whether or not the SPY is going to go to 400. Instead, what you have are investors who have almost an unlimited time horizon for their investment. So we're talking about primarily corporations buying back their own stock. Think about it. 10, 20, 30 years from now, as long as they think the central banks are going to keep printing out ridiculous amount of money and governments are going to go well beyond their tax receipts for spending, well, that points to central banks printing money and inflating asset prices. So a corporation has no problem buying its stock at all-time highs right now because, number one, they're not trying to retire in a few years. They're going to hold on to that as long as they need. And number two, the macro outlook is, even if we do freak out the equities market, in the short term, these banks have to print more money and increase the monetary supply. And to date, that has done nothing but inflate the equities prices and bond prices. So the caveat to that is the stock market is extremely news sensitive related to the U.S.-China trade war. So I am expecting that to not go away. And that will probably be what keeps the SPY bouncing around in this range, maybe all the way to the next election. 1 month view of the SPY. So we called that right around this range right here at 282. Said, hey, this is not the big dump yet. Look what's going to happen. We've got all the central banks getting ready to lower rates and print money, plus the corporate bond market is making records in terms of selling debt, which they're not using to grow their businesses. They're using to take away the float in their stock. Emerging markets, here's the 1 year chart on EEM. Now, if there was a trade deal really in the works, which could be just as simple as China's going to buy a crap load of food from the U.S., I think that would be enough to at least stall the trade war through 2020 and let these things go wild. So I would love to play emerging markets on the Tuesday play if we're able to get a significant trade deal, which I don't think has to be that big. I really think it could be as simple as some massive agricultural purchases, which would really help Trump solidify his 2020 election run. And I'll show you, they actually supposedly were making a good gesture agricultural purchase. And we'll talk about some of the rumors around that. Here's that 1 month view on emerging markets. Quite a nice rally, 10% rally just in the last month. TLT, we called the top 2 weeks ago. That's been paying off nicely. Although I do not think this is the end game for TLT. We'll be going long TLT the second the SPY gets a little bit hotter, and I suspect we're at the risk of another Trump tweet. And again, trying to time these Trump tweets is very difficult. Here's a look at the TLT over the last 1 month. Here's that 5-year view, or rather 10-year view. So we are at an extreme, but I believe this extreme will continue to force the hand of the central banks. I believe that the main buyers of these bonds, not just U.S. Treasuries, but all bonds that are sovereign bonds, especially negative yielding debts, primarily huge banks who are essentially hedging their equity risk, knowing that if equities get in trouble, bonds will be bid to lower and lower yields and higher bond prices. So they don't care that their bonds have no yield. They're only buying it as an insurance play in case something goes wrong. And so my expectation is this trend will continue until the central banks officially come in here and stop this ridiculous speculation in the bond market. And they're going to have to do that by essentially just buying up all the bonds out there, getting all these speculators out of the bond market, let them take their profit, and then peg their rates at something reasonable, which they'll probably slowly try to gradually push higher. So that's what I'm expecting. When that does happen, that could really push equities dramatically higher, as it'll mark the next round of QE. Here's that LQD chart, little sell-off, nothing big, not worried about that. Again, this is just a health measurement to tell us, do the top companies in the SPY have free access to capital? Okay, yes, they do, relatively cheap. Are they going to keep buying back their stocks? Well, yep, it sure looks like they are. Now, even the junk bond ETF doesn't look that bad. In fact, it looks like it's starting to get out of this kind of flat bear market over the last since 2016. So even the junk bond market's looking relatively strong in terms of its access to capital right now, which all points me to think we're not at the end of the bubble and that this thing is going to dramatically worsen before it pops. Okay, there's GDX. Again, I'm not worried about this sell-off, not one bit. Buy the dip. Again, if China were to say, all right, we're going to buy a ton of agricultural products, then I would say, all right, we need to really consider how we're playing the gold. Because at the same breath, we still have the central banks reacting in slow motion to what's been going on. Here's the most important currency conversion rate to keep track of the yuan against the dollar, the Chinese offshore currency. It hit 7.2 and now it's sold off to 7.1. I am expecting this is going to push towards 8 to 9 before things get really hairy. And if that's the case, this is another good leading indicator to predict stock market volatility. Every single time we see this spike, typically we're seeing equities have some trouble relatively quickly after. We're seeing bonds bid and gold bid, which makes sense. Another look, the 5-year. The German bond has been a great way to predict the U.S. bond market. And we have a small little breather from the descent of the yield into negative territory, which I do think will be pushed lower as we get the next trade war escalation. You can see the same pattern on the 30-year Treasury. Gold having a little sell-off, not bad. Oil bidding. Again, if oil gets too cheap, I'll be worried about our stock portfolio, probably increase our bond and gold position or risk. If I see crude getting hot, that indicates that growth is really starting to churn, and I'll be likely to want to be a little more positive on the equity side of our portfolio. And here's our Bitcoin sitting there at 10K, can't seem to go anywhere else. Ethereum, I really like right now. Again, these market caps are tiny. The total bond market's some $260 trillion. U.S. equity market something like $40 trillion. And we jump down to gold, something like $6 trillion market cap. And then we got a little Bitcoin at $185 billion and Ethereum at $20 billion. So Bitcoin and Ethereum I kind of look at a lot like silver relative to gold. If you want some extra risk in that part of your portfolio, currently those are the two I like the most. So I think those will be the potential big run. Now remember, Bitcoin to get to the high would just double to get back to 20K. But for Ethereum, get back to its crazy 2017 high, would go up to 1,100. So that is something like a 400 or 500% return from here. And again, I'm not betting big on that. It's 1% of the total portfolio, and it's just part of our buy and hold precious metals digital money portfolio. And there are some other coins out there that I like, just not yet. I need to see Bitcoin get to that 1,500 price, that's when I think Ethereum will really start to take off. And then I bet you start to see these little altcoins start to finally get a good bid. Here's the global money supply. Funny, more money supply, higher equity prices. So if we can predict that the central banks are going to increase the monetary supply, especially emerging markets at a faster rate than the U.S., that essentially helps drive lots and lots of capital into something a little more tangible, which is the profits of these corporations, which there is a finite amount of, and it's all relative to how many shares of their company you own. So this picture is continuing to point towards a much rapid growth in money supply over the next 12 months, which leads me to believe we can see all these trends continue to increase. All right, so we'll take a look at some of the tweets I've collected. I like to follow Donald Trump's Twitter account. Obviously, he can really move the markets. What's concerning me is this weird relationship he has with the media and with a lot of large corporations. Clearly, it's not been a positive relationship. So definitely paying attention to that. It's very important that we can predict who will be the next president, so we can see what those policies may do to our stock portfolio, obviously. And so I'm always concerned when there's this huge antagonism between the president and most of the major media companies. So that's definitely curious why that continues to not give in whatsoever. Some news on the AT&T deal, some CNN bashing, some MSNBC bashing. Now, on the same note, I'm also concerned that now we have a bunch of photos coming from Hong Kong. I thought with Carrie Lam saying that they're going to remove the extradition bill, which then Kyle Bass came out with hours later saying, oh, she hasn't really removed it. She said she's going to remove it when they reconvene in a month. So they're just trying to push it past that celebration happening in China. I think it's their 70th year anniversary on October 1st. Are they really going to remove it? They have 5 demands. They only got 1, maybe. And the violence and the protests continue. In fact, now they're throwing up American flags. I've got a photo of President Trump, please liberate Hong Kong. We've got him wearing MAGA hats except for Hong Kong. Trying to see if I have any more photos from there. So clearly the tensions in Hong Kong are continuing to escalate despite supposedly China allowing Carrie Lam to remove the extradition bill. All right, so let's take a look at some other news. Rate expectations with that sell-off in the bonds, probably just a 25 basis point cut is most likely come next week for the Fed. ECB, we'll see what they have in stock for us. Implied cuts in the next 12 months are 100 basis points for the Fed. But my expectation is they're going to drag their feet and do it as slowly as possible, which I think is smart myself. Not that that matters what I think. China will offer up to 5 million won subsidies for pig farms. So I'm continuing to watch the food problem in China get worse and worse, which would tell me why not buy some U.S. farm goods and take a little break from the trade war. So if we see that the Chinese are facing inflation in their food prices, which is terrible for 1.4 billion people who live there, but yet they still are so stubborn that they will not buy any farming goods from America to try to put some pressure off on their own people. It shows me that they're very intent on trying to drag the U.S. into a recession ahead of the election. So as silly as this whole farm goods and inflation and food prices may seem, it may be the single piece of news you need to follow to be a foot ahead of everybody else in terms of what's going to happen. There's just a look at the GDPs of the world. The United States is still big enough to really punish China. So we'll see. How much pain does China want to take? Will they ever cave in? How much pressure is Trump willing to put to get what he wants? And would a simple farming deal be enough, at least for right now, to get a massive equity rally, potentially right after we get all these central banks becoming more and more dovish in the next 2 weeks? This is a funny thing, but interesting. According to his tweeting patterns, Trump sleeps between 5 a.m. and 10 a.m. The president's account activity by time of day has remained rather consistent since taking office. 12 to 2 p.m. is the top hour for a tweet, and his sleep schedule appears to run from 5 to 10 a.m. I'd say that sounds about right. China's state media reports China will not tolerate attempts to separate Hong Kong from China. Okay, but yet we have the U.S. flags all over it. They have to be pissed. And this is leading up to their 70th year anniversary. What could you possibly have happening next door to you? It's supposed to be your province that you own, and you got them running around with U.S. flags. And you're supposed to have this 70th year anniversary. So that's why it's just so risky out there. It's so hard to predict when the next flare of escalation will happen. Then we get this news. China accuses Apple and Foxconn of breaking Chinese labor laws. Oh, great. Well, Apple has 1 million employees in China. So this has been something we did play Apple for quite some time, and the Tuesday Play did very well with it. And they have a new phone released tomorrow. I'd like to be long Apple right now, but I would prefer to grab Apple after some sort of devastating blow between U.S. China that does start to put a punch into Apple. Because remember, we're stabbing essentially their version of Apple in the back, Huawei. There's no way they can be happy about that. But yet they haven't struck back against Apple because it would also remove even more jobs from their economy. So been carefully treading the idea of playing Apple, just not yet. That's why I do like Facebook and Microsoft. They're relatively removed from the China story, but they're still top notch in the SPY in terms of holdings. London is only the 6th most surveilled city in the world. One of the things happening in Hong Kong is they're running around with broomsticks and golf clubs, and they're breaking all these cameras that automatically recognize your face, send out traffic tickets, all sorts of crazy stuff in China. But you can see that most of the most surveilled cities in the world are Chinese. The surveillance state. Okay. Here's the most interesting news that would dramatically change our outlook. China has offered the United States high-ranked trade officials to buy a modest amount of U.S. agricultural products during a phone call earlier this week in a peace gesture ahead of trade talks, or in front of their 70th year anniversary coming up October 1st, because they don't want America putting on the heat right when they're trying to celebrate how great their Communist Party is. And growth, and how they're going to take over the most important country in the world, and get out of their 100 years of shame. And China just enacted a major stimulus plan with all the tariffs that they are paying the USA, billions and billions of dollars. They need it. In the meantime, our Federal Reserve sits back and does nothing. So we know the central bank is essentially a leg of the banks, and we know the banks are highly connected to the economy of China in terms of not only taking billions of dollars from the Bank of China, they've also invested billions of American dollars into China. So, again, is Trump fighting against the media companies, which are mainly owned by huge corporations? And is he also fighting against the big banks who are partnered up with China? Things could get rather crazy quick. So definitely, if the Fed were to not drop rates by at least 25 points next week, I would definitely be extremely concerned as to what's really going on. This was, I think, Sunday. Oh no, this was 3 days ago. Railway stations closing in Hong Kong as protests continue to wreak havoc, so that's not dying down. Gold flows hit record highs. Central banks are loading up on this, not necessarily the U.S., but we already had a ton of it, but China and Russia primarily are. There has just been one buyer of stock since the financial crisis, so stock buybacks that they're talking about. Everyone else has been a little bit leery for good reason. Junk bond issuance hits $167 billion year to date. Wow. So that's the worst of the worst, is getting almost unlimited capital right now for whatever it is they want, mostly stock buybacks. Corporate profits used to mainly go to CAPEX. Now corporate profits go to dividends and buybacks. You can see the blue and the growth of the buybacks over the last couple decades. Okay, now who's going to be fighting Trump for the presidential spot? I thought the media was really pushing for Kamala for quite some time, but just not seeming to work out for her in terms of all the odds and betting gigs out there. Right now, looks like Elizabeth Warren is the front runner. I don't think they'll let Bernie in there, even if he had the popular vote. He's too anti-corporation. And then Joe's been just struggling. Slow Joe, what do they call him? Dinosaur Joe. So definitely keeping a look on that. But will there be a surprise person to hop into the race? Would Hillary come back? Would Michelle Obama come in? We already know Bloomberg's out. The Starbucks guy dropped out, who's going to run independent, I think, just this weekend. So just something to keep. This is a ways out, but this could dramatically affect the market. So we got to keep up on that. Fed Powell had a speech Friday in, I think, Switzerland. Didn't say a whole lot, just pretty much said that the U.S. economy is in a good place. Mentioned Libra, and I kind of said he's going to support the expansion. So a lot of the analysts are saying that it is saying that he would probably do at least 25 basis point cut. All right, guys, that's a wrap for the content I have collected over the weekend. Let's see if we got anyone else. We still got 9 people live. If you have any questions, please post it in the chat. And don't forget, if you want to figure things out. All right, Scotty says, I entered my first trade alert for PB trial. Looking forward to tracking. Thanks, Dean, for your help. Hey, thanks for chatting with us live, Scott. Really appreciate your interaction. And don't forget, we do this every day, so you can chat with me daily. Plus, we do have a webinar. So if you actually want to get a microphone by Thursday, plug it in, test it out. You can actually talk live with other members, and oftentimes real customers will join it. If you listen to last week's, Karen hopped on and talked about her results. Some of the people on there were saying, wait, are you affiliated with these guys? And she said, no, I'm just another follower of the program. We have over 100 people now, people of all sizes. We got $30,000 accounts. We've got $3 million accounts. So thanks again, everyone, for your time. Look forward to a new trade alert tomorrow. If you don't want to miss out on trade alerts, make sure to call Dean, 505-322-7515. Thanks.